Hello, it's Geek Austin, founder, CEO of Dakota, and I want to talk about Rainmaker Live. It's a show that we go through everything that we've learned over the course of our lifetime, really, in sales and fundraising, and we share that. Think of it as best ideas, but there's a lot of myths out there that we basically unbundle, if you will. We demystify the things that you should be doing, we all should be doing to get leverage, and that's the theme. The theme is all about leverage. What can a salesperson do to get leverage? And there's a few key points that we're going to go through that are really game-changing. So you don't want to miss it. Please register below. Join us for another Rainmaker Live. You don't want to miss this episode. What's up, everybody? Geek Austin, founder and CEO of Dakota. Just wanted to tell you, we have just released a new podcast called Fundraising News. So those of you who are subscribers to Dakota Marketplace, you know that in the upper right-hand corner of our homepage is our fundraising news, where we roll out 6 new articles a day, all related to fundraising. As you know, tracking all of this information is very difficult. Well, we've tried to make it very convenient for you to be able to stay up to date on all fundraising news by releasing a 10-minute fundraising news podcast twice a week, simply going through the different news items hosted by Pat Ty and Conch Mua on our team. So where it can be found is in the App Store on Dakota Fundraising News, or you can go to Spotify or iTunes and you can find it in the podcast sections, where all you have to do is type in Dakota Rainmaker Podcast, and Fundraising News is located in between the interviews that we do with distribution leaders. Fundraising News is awesome. You can listen on your way to work. It's chock full of really useful information. So please listen. Have a great day. What is up, everybody? It's Geek Austin, founder, CEO of Dakota. Welcome to the 27th episode of the Emerging Manager Growth Show. I'm joined by my partner, Tim Dolan. Tim, thanks for being here.
Of course, thank you.
So as you all know, over the years, we get a lot of questions from emerging managers. We, as Dakota, have always worked, Tim, with emerging managers. I mean, Edgewood Management, when I first met them, was $2.3 billion. That was 2005, 2006. They had a $25 million mutual fund. Hamlin the same way. Spyglass, we're catching these guys all early in their growth, always as emerging managers. So naturally, we've gotten all these questions over, hey, you know what, I'm an emerging manager. I'm trying to figure out, I need to do more with less. And that's really our theme here. So we've always worked with emerging managers. In fact, we just took on Spruce, private credit manager. They do whole construction loans to multifamily developers. We're 2 years in with Spruce, an amazing firm. But again, existing strategy, 15 years, but new channels. Mostly right now, RAs, multifamily offices, family offices. I only bring this up because even as a firm that was founded in 2006, Tim, we're not new to work with emerging managers and taking an existing firm to a new set of relationships. And so we're all walking the talk. We're doing exactly what you're doing. So we're here to share today in the next 20 minutes around RAs and how to, as an emerging manager, how do I attack the RA channel? We have had a lot of action in 2024 in terms of raising capital and closing business. Any thoughts you want to give just in terms of emerging managers, our people listening? And
yeah, absolutely.
A lot of thoughts.
I mean, we're here now in the kind of second, third week of the year in 2025, and just got off the road in Chicago. And I think what's exciting is through cold outreach and through a focus on the right set of buyers for our strategies, is people are taking meetings, allocations are being made, searches are definitely happening. We see it in the search activity. We hear it in our conversation. So we're excited, whether it's a brand that we built like Edgewood over the past 18 years, or with Spruce that's relatively new to these set of buyers, getting out there and folks are willing to listen, which is great.
What was pretty funny about Spruce is that I talked to Andrew Shea yesterday. That's one of our institutional sales guys for this 10, 12 years. Spruce, real estate debt strategy. He called on one of the largest multifamily offices in New York, $75 million minimum. And no one's going to call on them and try to sell them a real estate debt strategy because they have some of the largest billionaire real estate families as part of their multifamily office. They immediately got the strategy and were like, this is exactly what we're looking for.
Yep.
Meaning most people would have shied away from selling a real estate debt strategy to successful real estate people. And those are the ones that actually get it. So again, is back to someone who's asking me today on the podcast, what are some of the secrets to fundraising success? I mean, calling the people that have capital and potentially buy what you sell, because you never know who's going to like you.
And I
That
think also
consistency.
just removing any biases like that you might think are out there in the market, right? That family office, right? Oh, their clients are wealthy real estate guys. They're not going to look at this. It's like, you never know, right? That is a pool of capital, right? That is in New York City that allocates in size. Just get an answer from them or try to get an answer from them, right? So removing that bias, and again, that's self-created bias. It's not anyone telling us
It's
that.
incredible, right?
Yeah.
That's kind of been one of my themes recently about creating these make-believe. Now they're real biases to you, but they're make-believe in the world.
Exactly.
Because you don't know who's going to like your strategy, but you got to ask.
You never know.
Right? And fundraising is a face-to-face game. It's hand-to-hand combat. In order to raise capital, right? That's one of the biggest takeaways of this show, is that you have to consistently be sending emails to book meetings with potential buyers that allocate capital, and to tell them your story.
Yep.
Now, if you're a $100 million private equity fund and you're not going to the emerging manager program at a public pension fund, might not be the best target right now. But that being said, today we're here to talk about RIAs. So money's been in motion.
Yep.
We've been proving it through emerging managers. We're not here as a bunch of salespeople working for a big brand. I only say that because if you're here listening into this show, this is targeted for emerging managers. So we walk the talk. We are you.
Yep.
Let's talk about some myths within the RIA space. And before we just get there, I just want to emphasize that we have two businesses. One is a fundraising business. The second is a database business. A database, if you're not familiar with it, is Dakota Marketplace, similar to Preqin, Money Market Directory, FinTricks, FinSearches, those types, Discovery. And we have over 1,300 investment firms, 6,000 fundraisers. Only reason I say that is we've applied the same sales methodology to both companies. And it's the only reason we're successful in terms of, it's because of the distribution, the consistent application of booking meetings with potential buyers. That's it. And so I wish I could tell you that there's some magic bullet, a money tree, something easy.
Yeah.
It's a consistent application of sending emails to book meetings on a daily basis that gets you your meetings, gets you your size to then do the meetings, then build a pipeline.
Yeah.
So I think that's just
Absolutely.
really important, Tim.
And I think also for emerging managers, right, we get asked all the time, right, maybe we launched a new strategy or we have a track record, we're small, like where should we go? How should we attack it? We always think about it, right, from an investment standpoint, that product structure drives channel coverage, right? So today we're going to touch on the RIAs, but as an emerging manager, right, you still have the consultants, the pensions, the foundations, the endowments, right? The bank and broker dealer might be a little longer in the tooth, but RIAs today specifically are ripe for emerging managers. Reason being is they're highly sophisticated investment committees that can move fast and can move early, right? They want differentiated product because that's their product, right? Is their portfolio. They need to compete with other RIAs in their region, their territory, their town, et cetera. So they actually need us to call on them as emerging managers to help differentiate their business. So that's very important. But
yeah, so if you have one myth that you actually believe you're bugging an RIA, then you couldn't be more off base.
Yep.
They depend upon salespeople to ping them with emails that make sense, they're easy to understand about their strategy. So you're essentially, through all those emails they receive every single day, they're building a catalog of investment ideas.
Exactly.
And that's only from feedback that we get from the $12 billion that we've raised as an RIA channel. So we do it every single day.
And we get a lot of questions. All right. So consultants might take a few years, pensions might take a few years. How long does it take in the RIA space? And to my point, they can move fast, they can move early. I only say you only need 1 or 2 a year to really grow your business, especially if you're small or new, because they do allocate in size, kind of the $5 to $25 million. But if you get a couple of those each year, 2 to 3, right? Yeah. That gets you to certain thresholds as you grow your strategy over time. So it might take 6 to 9 months to a year or 2, but what's great is they do allocate, which is nice. And
it's a good exercise because if we're dealing with the rule, not the exception, the consultant world to win would be a sales cycle between 5 and 10 years. Sales cycles in the RA channel, if your strategy is cogent, which I'm assuming it is, and it's good, it could be 3, 6, 9, 12 months.
Yep.
You're very rarely going to get under 5 years in the consultant channel. So the question you have to ask yourself when you peel back the onion and you say to yourself, all right, taking an old school yellow pad of paper, if I draw a T and I put RA discretionary assets, consultant, because a lot of people like to call them consultants, because they think there's a win there. The time period it's going to take over there to get any money out of the ground versus the RAs. Right? There really isn't any comparison. It should be, all of your focus should be on the RAs. Why? Because they're the same type of pools of capital. They have the same asset allocation models. They have the same just about everything. They just have discretionary capital and they can move fast.
Well, it's as emerging managers, right? Especially for new and for fundraisers, it might feel warm and cozy calling on the consultants from an activity standpoint.
Yeah, it might you look good, but
yeah, exactly that point. But at the end of the day, is there an end zone? Can they write a check? And it's
just going to put a very, very long time if it ever happens. We have seen very, very different outcomes within the RA channel. So we're here to give you the raw, honest, straight opinion based upon experience and what we're doing every single day and getting anecdotal evidence every single day. So cold outreach to RAs on a consistent basis. Tim, define the RA channel for the audience. If you're not familiar with it, how we think about it, especially from a Schwab Fidelity perspective, the types of RAs that when we say RA, it resonates maybe a little bit differently than most people.
Yeah. So what we're talking about is the true independent RA accounts, right? There's 32,000 registered investment advisors at the SEC, but there's really a subset within there that use outside managers that allocate to your strategy, our strategies, if you will.
And if you're an emerging manager, it's not like you have, a territory of 1/10 of the country, right? If you're an emerging manager, you're going to have the whole country.
Exactly.
So like in our database in Dakota Marketplace, we have roughly 3,000 RAs that we've deemed to be qualified to use outside managers, meaning they're qualified buyers and they're people you want to call on. And so look no further because you probably can't make 3,000 sales calls in a year. So
and we do get asked, right, where do they range in terms of AUM and size of these RAs? Right. It's kind of roughly 200 million and above. Some of the larger ones, 25, 30, 50 billion in size. Some people ask, it's like, hey, should I go below $1 billion or should I only focus on a certain size? It's a resounding yes. And one of the main reasons why is the smaller ones, again, they need to differentiate their business. So they need you to call them. They need your strategy. They just need to get to know you if it makes sense and if it's a fit. But also, I mean, we see it every single day with all this M&A activity in the RA space. These smaller RAs are merging with the likes of a Crescent or a Cerity or a Corio. And if you're in their portfolio and they get acquired, you just went from a $300 million RAA to a $120 billion RAA in an example of Cerity. Right?
Listen, I'm not suggesting that you should be spending all your time calling on $150 million RAs. You should call on do it by metro area, do it by Boston, but don't call in the top 10. Call on the whole list.
Yeah, exactly.
Dakota Marketplace, call on the whole list. So you might say to yourself, Guy, that's great. Well, what if you win a $2 million allocation from a $150 million RA? Well, how do you not know that one of their best buddies runs a $700 million RA that introduces you? Yep. And how do you know that it doesn't go like that? So try not to overthink the size. I would focus much more on where they custody.
Exactly.
And are they making their own investment decisions? Are they institutional type approach? And those RAs grow. That $150 million RA just with appreciation is probably growing 10% a year. And then you put on some organic growth, and then all of a sudden they're going to be 250, and then they're going to be 500. And
a lot of these RAs from a fund structure standpoint, back to my starting comment, are utilizing strategies, separate account, UMA model delivery. A lot of them use InvestNet as one of the largest back-end systems for model delivery, mutual funds and ETFs. And then absolutely on the alternative side, RAs are allocating to private alternatives in a limited partnership format and even some interval funds as well. So at the end of the day, they'll look at all types of strategies across all structures. Just to go through a couple examples, Guy, as I touched on kind of that M&A activity, there's a handful of RAs that are a must know in terms of these aggregators and calling on them from a home office, and then the underlying RAs across the country Dynasty Financial, Focus Financial, Hightower Advisors, Sanctuary Advisors, Rockefeller, and Cerity. And then a couple examples. These are all in our database in Dakota Marketplace.
And they'll be in the follow-up show notes from this call, so you'll get these in your email box right after this call.
Thank you. And a few kind of early adopters that we know that will could potentially look at a smaller, newer strategy. William Blair out of Chicago is always open to interesting ideas. Corio Wealth, Crescent Wealth, again, growing through their acquisitions. GEM and MFO up in Detroit, and then Pitcairn and Trust here locally in Philly. We've had their colleagues on a number of our shows that are always open to interesting emerging manager strategies.
And then as I go, I do want to just touch on what we call fundraising best ideas. This information will also be in the show notes. It's set up around 4 categories, just happens to be how we've done it here. My book finally is coming out called The Dakota Way, which articulates our 4 core tenets of fundraising success. And it's everything that we follow on a daily basis. And so first off, you have the approach, right, is city scheduling. So as you said, if you're going to Boston, take the top 15 largest metro areas, probably one of the best ways to focus. Go into that metro area, go out and try to get to meet every single RAA in that market. And then go Boston to New York, to Philly, to DC, to Chicago, San Francisco, LA. Well, LA right now, tragically, and we feel very sorry for so many of our friends that have lost their homes. That's a tragic situation right now. But the top 15 metros have always been the very best areas to focus and go head to toe, largest to smallest, trying to book meetings and build relationships, get to know those firms.
One thing just on that, Guy, because we get asked, it's like, hey, we're an emerging manager, right? Do we have to travel? Budget's tight, right? We're small, we're new. Right. Stay local. Stay local. Yeah. Number one, hit your hometown, but also the city scheduling and the email outreach is just a forcing mechanism to cover accounts.
Yeah.
Right. So if you get the meetings and you get 4, we recommend going. But if you don't, just flip into a call and a Zoom call. Right. It's just a way to get your name and brand out there. So don't stress so much about the actual travel. This is an account coverage model.
And it's really important that you know that this is a lifetime commitment to cold outreach, sending emails, to be a professional meeting setter-upper.
Yep.
I wish it were different. It's a super competitive world in the investment industry, and you have to be committed to city scheduling. With that, just make sure your email is clean and tight. We have all those details, but subject line, meeting request, date and time, 1 sentence on who you are and why they should care to take the meeting, then a clear call to action. Can you meet January 15th at 11 a.m.? Followed by one of the greatest resources an emerging manager can utilize is simply hosting a quarterly webinar. We have an ebook that will send you on that as well that walks through how to throw that. We have the whole sequencing of the emails that you send out to build your brand, to invite people to that quarterly webinar. Then post-webinar, you have all of that great content to send out as get to know your firm type marketing material. Lastly, just to close out, like I said, all this information, the power of a CRM knows no bounds.
Yep.
So if you're an emerging manager, you're trying to do more with less, it's very difficult. You need leverage points. One big leverage point is having a CRM to enter the meetings that you've scheduled and your call notes. If you enter that information, you can run past activity reports. You can see where you've been, so you can have rapid recall on who you should follow up with. And then also just knowing what conversations you had with over 100 different firms. It's very difficult to keep in your head in an Excel spreadsheet or on a yellow pad of paper. Then lastly, you want to be able to run pipeline reports. That CRM will give you that capability as well, so you can enter the opportunity and run your pipeline reports, which also triggers sales actions and allows you to manage your follow-up and trigger actions every single day. I'll conclude the fundraising best ideas because I think for an emerging manager, you're kind of happy you want to be in the good news world, but I do believe you have to ask the 2 tough questions to end the meeting. So we're in a meeting with an RAA, with a due diligence analyst. The meeting's about to conclude. Tim, what do you do?
You ask the 2 tough questions. So first and foremost, you look at them and you say, is this a strategy that fits in your asset allocation program?
Right.
If the answer is,
it's a very fair question. Hey, we've spent an hour together.
Yeah.
Would this be something you would ever, construction loans to multifamily, would you ever see this type of a strategy fitting in your portfolio?
If they say no, that's totally fine.
You know what the follow-up is?
Mailing list. But if they say yes, then the next question is can you meet the final close on December 31st, 2025? And if they say yes, that is in our timeline, then you go down, what can we do from a due diligence standpoint? Would you like to come on site? Should we send you the data room, et cetera? Go through that buying process. If they say no, we cannot meet that close, but there is a level of interest, keep them on the mailing list for subsequent fundraisers, or in the long only side, just keep them updated.
Ask the 2 tough questions in the meeting to know where you stand so you don't waste your time. The most important thing as we have as fundraisers is our time. Wasting time hoping or guessing or being ghosted and all the stuff that we know that happens after a meeting if you don't ask the 2 tough questions is lethal.
Allocators appreciate those questions because now you're saving them time and you're saving them all these crazy emails after. It's like, hey, enjoy meeting you. What can I send you? It's like, do that in the meeting. You have them right there. Just ask the questions.
Yep.
Yeah.
So in the show notes, there's all the detail here that supports everything that we're recommending that you do to do more with less. We're huge believers in emerging managers. We think that's the lifeblood of the investment industry. And you could be very successful fundraising at an emerging manager, but it does require the shoe leather. It does require consistently doing email, cold outreach to metro areas using city scheduling on a consistent basis. So with that, Tim, just want to say thanks for joining. I appreciate it.
Appreciate it.
We all appreciate you. Thanks for being here. Our next episode is February 11th. It'll be episode 28, Feb 11 at 1 o'clock. Again, thanks so much for joining Tim and I. We appreciate it. We'll see you on the next episode of the Emerging Manager Growth Show. Hello, everyone. I just wanted to say thank you for watching the Emerging Manager Growth Show. I hope you got a lot of value. And I think, as you know, we shared an enormous amount of information about metro areas and other type of information, RIAs, etc. All of that information exists in Dakota Marketplace. And if you're not a member, we would love to show you the platform. Just simply go to our website and get a free trial of Dakota Marketplace.